Hello, everyone. Welcome to today's session. Let's get underway here. So I apologize for the delay there. Um, let's jump right into market conditions. And we're seeing, again, as of yesterday's update, we're seeing momentum, which has been, pulled back. It's gone up to this extreme range just slightly. And now it's pulled back into this buy zone. And also seeing breadth. Breadth has been holding up. It's actually been improving slightly during this last run. And sentiment also is extreme, but working its way back this direction. So we're definitely towards the upper end of that range. We know that we had been extreme across the board. Now we've got a couple that are pulling back into that buy zone. We've got buy sell ratio, which is still nothing super impressive. It's just sitting slightly bullish at that 1.4. That's anything above 1 is still that overall bullish bias, that overall bullish trend. And sentiment, we've been hugging this upper range now this entire rally and really haven't had any significant retest here, even pulling back to that 50% line. So we're at an area certainly where we could see markets start to pull back. We've got S&P 500 here, potentially back into that retracement zone. But we're just continuing to move higher. It's been this real stable upward trend. And so we've got some support areas here. We'll see if we hold back up in this upper range, but this is now another all-time high for S&P 500. And now we're through earnings season. We're continuing to see now we're focused more on some of the economics. I believe there is some Fed news or some kind of interview. I saw part of it. I didn't look that closely in terms of what they're talking about, but essentially we're still dealing with the Fed interest rates and inflation, and along with that is dealing with bonds, because we've been talking about bonds possibly pulling back into this new uptrend, and we have a situation where interest rate, again, it's about what the bond market and the stock market is looking for the Fed to do. They're wanting to see the Fed say, yes, we're going to start easing, or we're going to at least change the perspective of easing. And that's kind of got the bond market moving that direction. One of the things I did recognize in the report, again, I just was watching it at the gym on the TV. So some of the closed captions as they were going through dealing with the economy. And so Powell's perspective was, if the economy cooperates, then we will probably be able to start easing. So they're kind of watching some economic numbers now as well. And we'll just keep an eye on the bond market right here and see if that gives us some indication. But in this case, yeah, bond market moving higher. We want to see bonds starting to continue higher as that happens, and we want to see interest rates start to move lower, flattening to moving lower. That's really one of the hiccups and the hangups currently in the market right now. We're continuing to see stocks go higher based on, in my opinion, it's still AI driven, and it's still productivity and efficiency and new technology driven. It's a very exciting technology, and it's going to affect every single industry. And that, I think, the market is kind of creating a repricing of assets based on that perspective. Now, that being said, these companies have to deliver, and the AI has to deliver, and it has to be effective, and it's got to do everything that all the hype is about, but it's still relatively early in the implementation of a lot of that AI. I don't think we all know how that's going to affect a business, how it's going to affect our lives. I went skiing yesterday with my son for a couple hours, and he's like, why don't you just tell Siri to pause your music? And I had my headphones in, and I'm like, hey Siri, pause, or hey Siri, play. And I'm like, I've never done that. And my Siri just activated. So I'm 50 years old, and my oldest son is 22, and I have 6 kids, and my youngest is 9, and so they're outpacing me in terms of how to utilize this technology, which is kind of fun. They're teaching me all the time as well. But my point is, a lot of these things, like for us to be able to talk and an output or talk and an outcome happen, is going to be more and more of the norm. And does that create efficiency? Does that create possible layoffs for companies? Is it going to be, or are we going to get a big spike in unemployment? Or is that or just jobs going to be moving to a different industry? Maybe there's something new that has not even been invented yet because of AI that is going to move those jobs into that area as well. Those are all, obviously conjecture and speculation, which I don't like to do. I'm not very good at that. I'm not very good at seeing the future. I know some people are really good at saying, oh, yep, this technology is going to do this, 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 and this, and so we need to be positioning ourselves for this, this, and this. And in terms of the overall technology and perspective, that's, this is nothing new. This is what stocks and economies have done for hundreds and thousands of years, and that is embrace new technologies. Really, my career has been the last 25 years in the stock market, and it's essentially, the dot-com boom and really the internet, the creation of the internet and cell phones and smartphones and social media, and now AI, and the way that we interact with each other as human beings. These are all just really cool things that are developing so fast that I don't know that we as a society know exactly what is going to benefit and how quite yet, but the markets are still moving higher, I think, based on a lot of those things. And at some point that's going to end. At some point that's going to reverse. And so let's talk today a little bit about, let's jump in. Let me get through some of these other sectors I wanted to go through and look at sectors, and then some commodities. We've seen a couple of little small hiccups here. So a down in consumer services, a short-term trend down. That was yesterday. So it's pulling up a little bit today. See if that holds. It's just been a really quiet kind of, nobody's interested in selling. Nobody's interested in buying aggressively yet either. Commodities right here, if we look at gold has been really having this big breakout trade. Keep a close eye on that. If we get confirmation and follow through. The only thing with the gold, and traditionally as gold moves higher, it's a flight to quality. It's a flight to safety against recession, against the US dollar, against a lot of different scenarios. And so the fact that it's breaking out and moving higher could also be interesting to where money may be flowing. We're also seeing oil, which is holding in this upper rung right here. The 6-month time frame, it's still grabbing this swing high and swing low. So it's still considering the 6-month time frame trend down. And so these are counter trend to a downtrend. Okay, so this 236 area, this momentum zone, this is our downtrend zone. So we've broken through some significant areas, and now we're at this 618 area. If we get up above that, this is a pretty fledgling rally in oil, but that actually could start to gain some momentum right here. I only bring it up because oil can act as a headwind, as a tax, as an additional cost to companies that can hurt the efficiency they're working so hard to gain. If they're laying off employees, but then oil prices double and they have to now spend more money on whatever that, the cost of the oil, it just adds additional cost, and that can come into play. Also, it's just, there are stocks that can move around USO, around oil, and everything. Crude oil and petroleum products are in literally everything that we consume and live and breathe, and so higher oil prices affect all of us, especially those of us that drive gas guzzler pickup trucks and USO. So that's kind of the overall kind of the perspective of the market conditions, and that is we're extreme in the long term. We know that. This line right here, I've seen it top out around where it is now, 21, 22, I think has been the highest I've seen that. And that, I believe, was either here or here. So we're at an area that historically, based on this indicator, is extreme. We're at a really extreme area. We're at all-time highs. The fact that we have gone straight up, we know that that doesn't last forever. But do we want to sell everything and go to cash? Okay, some of you might be in a situation where you can't deal with, or you can't afford, or don't want to have any volatility or potential risk of a downturn or a drawdown in a long-term portfolio, let's say, retirement assets, those monies are set aside and we want them to grow, but we also want to preserve those, right? We don't want to be aggressive in stocks to the extreme that it's adding additional risk to that capital amount. So the key right here is always about managing risk. And the only way to manage risk is with an allocation, a portfolio allocation. Number one is don't do anything. Sit in cash, but go to the bank and buy a CD, okay, for 4 or 5% for 5 years or whatever it's paid. Okay, the only risk to that idea is that if inflation is at 5%, then basically your money is break even over a 1 year time frame. I've always said that inflation, that perspective is a little bit theoretical because it's such a slow moving process that we don't feel it. But it's kind of an academia type of perspective, and it's real. We just don't live our lives that way. We don't live our lives thinking, oh, my money is earning 5% and inflation is 5%. We think of cash as a riskless asset, and that is that my money I know is going to be there at the end of 1 month, 2 months, 3 months, 4 years, 5 years. I know that money's going to be there, plus a little bit of interest. If that's the mentality and the risk level that needs to happen, then that's what needs to happen, and that's fine. But for a portion of those assets, if you want to be able to try and outperform 5% a year, then one of the best places to do that is in equities. And as portfolio management, what we want to try and do is we want to try and produce winners over time that give us some really good, upside returns in stocks that have that ability to move 100, 200, 300% over the course of a trend. And that trend might be a month, 2 months, 6 months. Typically, they don't last that long. Typically, they're, a really good one is going to be a year or so. VKTX really had this initial buy signal back here. I believe we bought it on a breakout. I think it was either right here or right here. It was where we added into that overall uptrend, and it's dipping a little bit lower today, but this upper, consolidation range, the possibility, the probability, the opportunity to have some part of our asset base increase by that much is really why we buy stocks, because that's the only game to be able to play that has that possibility with the risk level. Yes, you can get these returns really easy trading options, but the risk is really high and the volatility is even higher, to where you may be up 100% in 20 minutes and then down 100% in the next 20 minutes. And that is that's a different world. We're looking at a little bit longer term, 2 or 3 months holding time frames, and looking for the right stocks in the right trends. So in this case, it's been a nice uptrend. We've had some nice gains. We get stopped out of a few things along the way. We add into something new, and that continues to work as well. For example, PLTR, this was a new uptrend that had started to reverse. I think we actually may have bought it back here and been stopped out. And then now we've got this one and this earnings report here. We didn't get into that one, but I got into this one right here. So it's still relatively early, but it's in that upper momentum zone. And then we finally get a confirmation bar on nice volume as it's moving higher. PLTR is in that AI space. They do a lot with military contracts, and they really have a cool technology that I think in terms of AI is that can be an AI play. So those possibilities, those kind of stocks that are moving higher. Would we want to buy Walmart or Disney, or a stock that we know the name, but the stock may not have the potential to make us those kind of gains? That's fine as well, because we can simply just go and look for Dow type stocks. Let's go here and go to these index scans and say, okay, of the Dow stocks, these 10 stocks in the Dow, General Electric, who would have thought General Electric could be the kind of stock that could move 80% in a year? Well, it is, and IBM as well. Some of these stocks are really starting to take off. So there are plenty of Dow type stocks or large or mega cap stocks that we can also participate in, that have the same profile, that have the same trend direction, that have the same characteristics that we're looking for in a stock. This, IBM, there's our buy signal right here, or even right here within this overall uptrend, and that trend is just continuing to move higher. So if these are the kind of names that you're looking for, then you can still utilize this methodology, this trending momentum strategy, even on any of these stocks, and still get performance, still get positive performance, just potentially not the real big, massive run up. So here's Home Depot. Home Depot has had a move from here to here. That looks impressive, but in the last month, that's 5%. In the last year, that's 26%. Okay, so that's great, but that's too low for what we're trying to do. The kind of stock that this is the possibility for a really big run higher is just not there. So that's fine if we don't want that, but we kind of want this gradual move higher. Although even a stock like Home Depot can get pummeled, okay, and have really extreme volatility and move higher. But sometimes within the trending moves, it's a little bit smoother. Okay, so for example, back here, if we're looking at Home Depot and we're trading this direction, we're moving higher, okay, we would have been stopped out probably around either here or on this sell signal right here as well. We're out of this. Okay, we're out of that mess. Then we get, if Home Depot is a stock we follow, we keep it in our watch list. And we say, oh, sure enough, here we go again. Is it time to buy? Nope. Is it time to buy? Nope. Is it time to buy? Nope. Is it time to buy? Yep. Finally, here's our confirmation, and away we go. So the benefit of having a stock like, Home Depot or General Electric or Microsoft or Disney or whatever it is, you can still utilize those, but just add them to a watch list and wait for the opportunity for those trends to start to reverse. So point being is it's still about risk and it's about volatility. Home Depot, Home Depot is not going anywhere anytime soon, right? But the volatility in their business model certainly can, because it's us, it's consumers. We're buying all the stuff there, and if we can't buy stuff that's there for whatever reason, the economy is slowing down or cash is tight or situations like that, then a stock like Home Depot can certainly be volatile as well. The other thing that we really want to focus on with momentum is we're focusing on the newest ideas. Okay, we're focusing on what's happening in the marketplace right now. For example, this stock right here is a base material. It's a base material stock, chemical stock, but they deal with chemicals that are electrically conductive, like a semiconductor. So they're looking for things that are more conductive and faster than silicone and some of these other things that we utilize for processing and chips. So there's lots of things that are ancillary to the idea. Let's say AI. Okay, we're talking about chips, so obviously we're talking about NVIDIA, we're talking about AMD, but what about other companies that are along those same lines as well that have to do with that? This is a company that's in that space and it's moving higher, and that's what we want to be able to find, one of these stocks or two or three that are in these big uptrends and continue to move higher ultimately and give us some nice gains, and we'll let those continue to run as long as that trend stays in place. The other thing to talk about in terms of risk and risk management is, again, it's position size. Position size is always your first place to analyze, and position size means the size of the trade. So in this case, we're using 2.5%, and as that 2.5% gets larger, you'll notice here ALPN, it's sitting right at 3.38%. It's actually dropped a little bit today, but we're up 74% on this stock. And now I'm considering, trimming that back. The holding amount is at 4,500. You can see that number right there. It's a little small, but it's 4,500. I want to scale that back to around 2,500 or even 2,000. So taking 2,000 off the table of this stock and moving it back into cash. So as we have winners, typically I'll wait and do that once it doubles, once it hits that 100% move. But sometimes, market conditions are a little bit elevated, and we're back up to a few. I think we're 23 holdings right here. When we get up to 25, I'm going to, or around that number, it's too many, in my opinion, because we deal with just the added volatility. For example, if I have 25 holdings and all 25 of those stocks. And so let's say that my average holding price is 2,500. Okay, so that's about 50,000 of holdings. Well, if every single stock in this portfolio drops by 10% all on the same day, then this amount, okay, all of these are going to drop by 10%. That means this amount could also drop by 10%. So that's one of the functions, is what if every single stock that we had dropped by 10%? Okay, that's one of the risks. That's not as high of a probability, because some of these stocks are going to be doing different things on different days. Some are going to be up while some are going to be down. And so, but once we get to this number of holdings, to where all of these positions, if they all were to drop at the same time, that adds a significant amount of volatility, and that's just increased risk of more downside, especially where the market is at right now. So being able to keep that a little bit less, I'd like to try and start to whittle that back to about a little bit larger cash position here as well. That means we can do two things. We either sell our losers or we sell our winners, and we're going to start doing both. Okay, the winners we want to allocate. So let's take this ANF trade. Okay, not ANF, it was ALPN. So ALPN, it's had this really nice uptrend. We're up 76, 77%. It's just about doubled, but the holding size now is relatively large in the portfolio. After this uptrend, I still want to keep shares, but I just want to be able to secure or lock in some of those gains. So instead of selling the entire position, we can adjust this position by moving it, by selling. If I nail the right one, there we go. That 4,500, we just sell off 2,500 of that. So we still own $2,000 worth, which is, what, 50 shares or so. And the rest of that goes back to cash, and we start to adjust. That's how we sell the winners. Obviously the losers, if we're like, this thing is not working, let's either get stopped out of it or let's just exit it. If it's not working yet, I don't want this one to be one of the ones that pulls us down when we get a market downturn. So selling some of those losers as well. So there's definitely ways to be able to manage each of these holdings, make sure your cash positions are appropriate for the risk level that you're okay with. And if you're completely okay with the volatility, and it's like, oh, I'm fine. I realize there's going to be ups and downs. I realize that there's going to be volatility, but I've got to take a little bit more aggressive approach, because I really want to get these gains. I really want to work on increasing that portfolio and dealing with these kind of numbers, 20 to 30 to 40% gains per year on average. Something in that neighborhood for a portfolio is realistic. And some years are going to be way better, some years are going to be worse than that, but on average, that's then the stock market as a whole is what, around 10-12% on the high end over time, long term. And so if we can outperform that, then that's really the goal. If we can do it with less risk, then we're even better. Risk adjusted return, if we're 100% allocated in S&P 500, and if I had all 100,000 in S&P 500, I'm taking more risk because I don't have as much cash. Okay, the cash position here, all of these stocks could drop to zero, okay, and we still have money. That would be devastating, okay, but we wouldn't be done. And so in this case, it's a risk-adjusted return. We want to try and maximize the gains from the holdings that we've got, and still not be 100% fully invested, at least right now, with the market conditions. Now, this allocation size has run into scenarios where we get stopped out, or we're taking profits to the point that 20 to 22 holdings is about where we end up on average, maybe a little less, maybe a little more. In order to change that and realize, okay, if that's the reality of what we're dealing with this methodology, and we want to be a little bit more invested, well, then we need to start taking more risk here. Maybe we start taking 3% allocation instead of 2% or 2.5%. This becomes the number that we start to change. We can also change it to the downside. If I still want to just continue to add stocks and continue to go through the process, but I don't want to be taking on a lot more risk, then I just take smaller position sizes going into that. And eventually that's going to make each of these slivers, we still may have 25 holdings, but each of these slivers are just going to be smaller. Okay, so maybe we've got 25 holdings, but all of those slivers are a lot smaller, and they end up filling a box like this, and then we've got 75% in cash. Okay, that's how I prefer to look at and manage risk, instead of saying, oh, I'm buying this stock, I hope it goes up, hits this target, I made $1,200, yay, I'm done, now what? Right? I think for a lot of traders, that's the next question. Well, now what? I took these gains, or I got stopped out, or I'm doing this or that, or okay, well, now what? Now what's next? What should I be focusing on that's next? Do I wait? Am I looking for something new to be buying? Those are all questions that I think most traders and investors continually ask themselves, and they're great questions to ask. And so I'm just trying to provide one methodology to be able to help in that quest of growing and protecting wealth through utilizing stocks and managing risk, because that's really what we do. So these presentations are really designed to help you understand TradersPro, what we're looking for, why these stocks are working, new buy list stocks, high rank stocks. These are stocks that are moving this direction. Those are the ones we want to focus on. These are stocks that are working. Okay, for whatever reason, there's demand here. We don't have to know a whole lot of reasons why the transportation and trucking sector is continuing to move higher. It just is. Okay, we can certainly dive into that and understand and do more research and really solidify that perspective, which is great as well. But we don't necessarily always have to know all of the reasons. There's a big buy signal, there's massive volume, it's trending higher. Somebody or a lot of people think this thing's going higher, and that's kind of the trend momentum strategy to utilize. And oftentimes it's, you go from high, you buy high and you sell higher. The momentum just continually works as it's going higher. And this stock is becoming a great example, because it's, back here when we were looking at this chart, and I've used this before, this looked like a chart that had already run its course. Maybe it was, towards the upside, and I would have been saying, okay, it's gone from 19 to 40. So basically, 100% move from here to here. That's a fantastic gain. And then, we get lucky. Sometimes we do. Sometimes we're in the right trend direction for the right reason. And a lot of institutional money and people that do take the time to really understand every single unit of information about a company, we're jumping on that momentum, and we're taking advantage of that. And yes, we want to know why that's moving in general, and in this case, it was because of this new weight loss therapy that a lot of companies are being involved in. We're moving that direction to the upside on these kinds of stocks. So your first place to start are high ranking stocks. We're ranking every stock just so that we can get data in here, like the buy sell ratio. I want to know in the database how many are buys and how many are sells. I'm not interested in the sells, but I want to know how many are there, and eventually they may become buys. I just am not focused on those quite yet. I'm focused on the ones that are moving higher, ideally on a new buy signal, some increased volume, moving in the right direction, not taking too much risk, 2 to 2.5% position size, setting your stop loss in place, stopping out when it becomes a loser, letting the winner continue to work as long as that runs. If I could sum up the methodology in 30 seconds, then that would be it. We're just looking for the right stocks in the current situation, the current market environment, that are continuing to trend higher, and allowing them to do that, because that's where the market extremes work to our advantage, where you get FOMO and you get extra money, that extra volume that's being pumped into stocks, and they're moving higher and higher and higher because stocks are moving higher. So people are investing in stocks just because they're moving higher, and that ultimately pushes higher. Again, at some point the pendulum is going to switch and swing. It doesn't happen overnight typically, but we're getting pretty long in this trend right now, and wouldn't be surprised to see some kind of a retracement. I want to kind of wait for a few more things to crack and to break to really see that happening. What am I trying to do here? Let's go to S&P right here. And, we just haven't seen that. These days that are down just keep getting bought into. That says that institutions are still buying up this rally right here. And at some point that's going to reverse, but just not yet. So make sure our risk is managed, looking for new opportunities in stocks that have good trade setups, and managing risk from there. I'm going to end on that note. I sure appreciate everyone's time and effort. And again, if you want to join me in the Discord channel, the Muscle Wheel portfolio, to get the new buys each morning that we're managing and the stop losses on those, then there's a link in the description of this video to be able to access that wheel portfolio. And look forward to having you. We have I do a short video on each of the stocks that we add in each day, and then also a portfolio review. So I'll do a full review on stops, how we're adjusting stop losses, when we're adjusting stop losses. All that gets updated every morning so that you're ready to rock and roll. You've got all your positions in place, and essentially we're managing this portfolio together. And so far it's fun. When the market is moving higher, it's fun. When the market's volatile or moving lower, it's a little bit more of a challenge. But this is ultimately the methodology that we're employing and following, utilizing momentum trading. That'll do it for today's update. Everyone, thanks very much, and enjoy your day today.